Let me describe something I see all the time.
You made good money. You followed tax advice. You implemented a strategy that was supposed to reduce your taxes. And on paper, it worked. You created a large loss. Everything looks correct. The numbers check out. The reports show a loss. And then your tax bill didn't change. Not slightly, not partially, zero.
Wait, that's impossible. If I have a loss, that should reduce my taxes, right? That's the whole point of doing this fee.
That's what everyone expects, because most people believe if a loss shows up on the return, it automatically creates tax savings. But that's not how the system works.
In tax law, a loss is not the result. It's only the starting point. Whether that loss actually helps you depends on what happens next.
If you've ever done cost segregation, set up an S-corporation, bought rental properties, followed tax strategy videos, or combined multiple strategies because they were supposed to work together, this is where things quietly break. Not at the beginning, not when you're learning, but after you start implementing.
So this isn't beginner mistakes.
No, these are not errors from people who don't know what they're doing. These come from people who are doing more investing, more structuring, more advanced strategies. And that's exactly why the risk increases, because each additional strategy adds another layer that has to work correctly.
So the more you do, the easier it is for something to break?
Exactly, because the system doesn't evaluate strategies individually. It evaluates how they interact. And when one part fails, the expected tax benefit can disappear completely. This is where high earners lose money, not from lack of strategy, but from incomplete execution across the full system. Here's what most people don't realize. Tax law is layered. It doesn't look at your strategy and decide if it works. It looks at your result and runs it through a sequence of independent tests. So when you create a loss, that loss doesn't automatically apply. It has to be validated. Step by step, your loss must pass 4 gates. Each gate checks a different requirement. Each gate applies a different limitation.
And if I fail one?
The entire tax benefit collapses. Not reduced, not adjusted, blocked. The loss still exists, but you don't get to use it. A loss only matters if it survives every gate.
Okay, this one I know. If the business loses money, I deduct it.
Not exactly. The IRS doesn't start with your business. It starts with you. It asks one question first. How much did you actually put in? So let's say you invest $100,000 and the business generates a $500,000 loss. On paper, that looks powerful. But from the IRS perspective, you only have $100,000 at risk in the structure. So that's all they allow. The remaining $400,000 is not usable right now.
So I thought I saved taxes, but I didn't?
Exactly. This is where the illusion happens. The loss exists on paper, but it doesn't translate into a usable benefit. I've seen this in real situations. Clients run cost segregation, generate large paper losses, and expect a major tax reduction, but their tax bill stays the same.
That's crazy.
Because they didn't have enough basis to support the loss. And another common misunderstanding, people assume loans automatically increase basis. In S-corporations, that's not always true.
So I think I have $500,000 in exposure, but the IRS doesn't see it that way?
Correct. Not all financing counts the same. And if it doesn't qualify, it doesn't increase your ability to use the loss. So if you've taken distributions, haven't tracked your basis, or relied on loans without understanding how they're treated, your loss may already be limited before any other rule even applies.
Okay, but I have loans, so I'm at risk, right?
That's what most people believe. But the IRS looks at it differently. It asks, did you actually lose money if things fail?
But I signed the loan.
Signing is not funding. There's a difference between being connected to the debt and actually bearing the economic loss. For example, a bank lends money to your company and you personally guarantee the loan. From a business perspective, that feels like exposure. But from the IRS perspective, the bank provided the capital, so the bank is still the one at risk.
So the bank is at risk, not me?
Exactly. Unless you've actually put your own money in or become directly responsible in a way the IRS recognizes, that loss may not be considered yours. And this is where it matters. You generate a loss, you expect it to reduce your taxes, but when the at-risk rules apply, the IRS can block it.
Again?
Yes! Same outcome, no usable tax benefit. So if your strategy depends on financing, but you didn't actually fund the investment, this is where it breaks. Third gate, passive loss rules.
This one always confuses people.
Let's simplify it. The IRS is asking, are you actually involved in the activity? Not ownership. Involvement. If you're not actively participating, then the loss is treated as passive. And once it's passive, it's restricted. Here's a common example. You own a rental property, you hire a property manager, and you're not involved in day-to-day decisions. From your perspective, you're the owner. But from the IRS perspective, you're not actively participating. So the loss is classified as passive.
So even though I own it, I can't use the loss?
Correct. The loss doesn't disappear, but it's suspended. It stays there until you have passive income to offset it. And this becomes a bigger issue for high-income earners, because passive losses generally cannot offset W-2 income.
So if I make a strong salary, this loss doesn't help me?
Exactly. You can have a real loss, a real investment, and still see no impact on your current tax bill. So if you have W-2 income, own rental properties, and aren't materially participating, your losses may already be sitting there unused. Final gate, even if you pass everything, even if your basis is sufficient, you're at risk, and the activity is non-passive, the IRS still applies one more limitation. This is where many people are surprised, because they assume once all the rules are satisfied, the loss is fully usable. But that's not how it works. There is a cap on how much loss you can use in a single year.
Wait, after all that, there's still a limit?
Yes, even after passing every prior gate, the loss can still be restricted. For example, you generate a $900,000 loss. From your perspective, that should significantly reduce your taxes. But under these rules, you may only be able to use around $300,000 of it this year. The remaining amount does not disappear, but it's not usable today.
That's brutal.
This is where expectations break. People plan around large losses, expect significant refunds, and then see very little change in their actual tax outcome.
So it feels like the strategy failed.
Not because the strategy was wrong, but because the limitations weren't understood. Yes, it carries forward. If your loss is limited today, it doesn't disappear. It moves forward to future years. But even then, it does not fully offset future income. There is still a limitation. Under current rules, it can only offset up to 80% of your taxable income.
So even in the future, I still can't use all of it?
Correct. Even when the loss becomes usable, it is still restricted, which means you can still owe tax in a year where you have carried forward losses.
So the benefit is delayed and reduced.
Exactly. That's why timing matters. A loss created today does not guarantee a full benefit tomorrow. The hardest part is most people don't realize this until after they file, after the return is done, after the numbers are final, after they expected to see a lower tax bill and didn't.
So by then, they can't fix it easily.
Exactly. Because at that point, the structure has already been applied, the limitations have already been triggered, and the outcome is already determined. Fixing it doesn't mean changing the return. It means addressing what caused the limitation in the first place, and that usually requires time, restructuring, and waiting for future years.
So the realization comes after it's too late to benefit from it.
Yes, most tax mistakes don't feel like mistakes until the result shows up. This is why people fail. They learn one strategy at a time. They apply it correctly, but only in isolation. But tax is a system of gates. Each rule builds on the next. Each requirement depends on the previous one.
So I didn't do it wrong, I just didn't do all of it.
Exactly. If you've already created losses, don't assume they're helping you. Because many people look at their return and think, I saved taxes. But they didn't. The loss exists, but the benefit doesn't.
So what should they do?
Before doing more strategies, check if your current ones actually work. Not just on paper, but through the full system. Because in tax, strategy is not the win. Usable result is.